get some insights in the news shaping the markets. For that, we welcome in Dana Doria, co-CIO at InvestNet PMC. Thank you for being with us. So we got a CPI print yesterday, hotter than expected. You had at least one Fed member today saying, look, the Fed follows the PCE. This was maybe, it was one piece of data. What do you think the Fed is looking at these days as people are anticipating those cuts still, but maybe push back some?
Yeah, I think, it's not surprising where the Fed came out on this. And I thought it was important that they said, look, this didn't really surprise us. We are looking to PCE. They're obviously also looking to your question on where does employment go, right? The Fed's mandate is inflation and employment. And with a really robust employment picture, there's not a lot of reason to think that they should be rushing these rate cuts. And, it's interesting. The market obviously reacts pretty strongly, for any new piece of data. Not surprising, the Fed has said they're going to be data driven about this. But we were the market was predicting so many rate cuts not long ago, even starting in March, and there wasn't ever really a good reason for that. Particularly when you see the economic data that's been coming in, there's not a suggestion that recession is on the horizon. There's not a suggestion. I mean, little cracks maybe. Hours were down in January, but other than that, not much of a suggestion that there's a crack in the employment picture as yet. So the Fed has no impetus to rush this. And I think they were being honest when they said, look, this inflation print isn't surprising to us. We've already kind of talked about the fact that we're not going to be doing anything in March. So this isn't a change to that.
Yeah, understood. So at this point now, they run the risk if they cut too soon, right? And inflation, pops back up. And so with that, how about Bitcoin? Are you watching Bitcoin?
Yeah, well, certainly on the InvestNet platform, because we have, so many different asset managers, so many different types of portfolios, the SEC approving spot Bitcoin ETFs was, a pretty interesting development in terms of retail investors. I think, a lot of people had gotten access to Bitcoin through, standard kind of embedded finance plays, but now you've got an opportunity to invest in Bitcoin that is much more accessible, backed by major asset managers. So I think we're going to see, significant interest that otherwise would have been on the sidelines for Bitcoin.
Yeah. I know you said recession isn't on the immediate horizon. We're watching the jobs picture very closely. That's another factor to keep an eye on, right? How do you feel about what we're seeing for wages and jobs?
Yeah, I mean, the increase in inflation, I think, has outpaced a lot of, in terms of wage increases. It's still, we're still not getting to a point, I think, where the average person is better off. And, the inflationary bite that has been taken out of their their purchasing power. I'm not sure we've gotten to a point where wages have really made up for that. Based on the data that we see. So I think we might still see increases there. And certainly the Fed is watching that very closely, right? That's one of the things the Fed's going to be focused on, right? Because is there a balance between supply and demand and jobs? And the Fed's job is to try to cut job openings, but not cut jobs. And wages are a big part of that. So they'll be focused there for sure. And I think the other thing to remember about inflation too is that, even when the increase in inflation comes down, the levels are still much higher than where we were, especially the way things happen so abruptly, so quickly. People are still needing to get used to this different price level.
Right. And I love your phrase about when people have cash on the sidelines, you said it's time in the markets, not timing the markets. You feel people should be invested, right? How should they go about that?
Yeah, look, it's an age-old adage, right? I think 2023 was a remarkable year for, any kind of story or anecdote that you need as an advisor to talk to clients about why it's not a good idea to try to market time. If you look at where everybody was at the beginning of 2023, given the fact that the Fed had increased rates so dramatically, it was expected that that would result in problems for the economy and ultimately problems for the market. And it just didn't materialize. Right now, if you look at volatility intra-year last year, the S&P had a period of time where it was down significantly, more than 16%. But if you just held out to the end of the year, you had a 26% return in the S&P. And this is, during a year where we saw a lot of people going to cash. Because not only were they hearing that, hey, the markets are going to react very poorly to what the Fed had to do to tamp down inflation, but you also have great cash rates for the first time in years. You can get significant return on cash. So money market assets last year swelled really, dramatically to 6 trillion in cash, probably far more than what, an asset allocation plan or a financial plan would dictate that a client needed, because because of these two different forces. And sure enough, by the end of the year, if you were just stayed in that 60-40, you would have way outpaced your cash return. So I think we've all, it's another anecdote in a long line of anecdotes around, yes, whether you're trying to predict or not, you better stay in the market, and you got to get those up days, and you got to be willing to expect the bad days that come with the up days. It's worth it. The net is worth it.
Yeah. Dana Doria, thank you so much. InvestNet PMC. Thank you, Dana.